Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 9th, 2025. It's 10:55 a.m. Eastern Time, so I'm starting the video. So we're a couple hours into the trading day, and here's what I'm going to do in this order. I'll start with a very brief update on the equity markets, and again, I'm not going to spend a lot of time there because Wednesday, tomorrow, 2 p.m., you get the Fed announcement, Fed rate cut. We're still looking at high probability, close to 90% right here of a rate cut tomorrow. So again, that's what's expected. Anything different would obviously cause volatility in the markets, but more so than the 2 p.m. announcement that they're going to cut a quarter point. Most likely would be the what Powell says in his press conference after. That starts at 2:30. So me personally, as I tell you, I typically do on important Fed weeks, and pretty much everyone for the last few years has been. There are times where Fed meetings are non-events. But obviously, in the last couple of years, they certainly have been. Market hangs on everything Powell says and does, and what the Fed does. So, I took yesterday half the day after lunchtime. I took the rest of the day off, and I'll be doing that in and out until the Fed announcement tomorrow, and then we'll see which way things go. So let's dive into the charts. And like I said, I was out yesterday. I'll catch up on any comments, chart requests as soon as possible, right after I finish this video and get it out to you guys. So let's go back to the charts. Let's look at the weekly chart of QQQ. That kind of paints a big picture too. You can see we're pretty much where we were about a month and a half ago. So we've gone up a little, down a little. We still have the bearish engulfings that we put in on the weekly time frame a few weeks ago. Those are still very much intact. Potential topping sticks. Get potential, and should the market push up to make a marginal new high, just like it did back here after putting in that high, it will most likely fail as a breakout, and that has been the pattern for quite some time. So on this weekly chart, again, you have this uptrend line right here, which broke down back test the bearish engulfings, and then you have the primary uptrend line, which also is on the daily chart right here, comes off the April lows, and that trend line was broken with this big red candle, back tested, rejected so far. So this is kind of formulates the bigger picture and says where we're likely headed in the coming months plus. When you look at the weekly chart, you go to the daily chart. Yeah, I don't know. Remember I said I had question marks. We're getting a little big for a right shoulder here. I talked about this potential head and shoulders pattern. We'll see if that one plays out or not. But so far, we're not seeing the down move you need to see. Now, based again, guys, where we're at today, it's Tuesday. I don't expect the market to do anything. So that's why I'm not sitting in front of my desk much today, tomorrow, yesterday, until after the Fed meets. The market's going to, and it goes into a holding period, pretty much, a lot of stocks. Who wants to bet anything really hard in either direction? Right in front of the Fed. I mean, there's always gamblers in the market, but again, that's my experience. So, barring any unforeseen news headline, we'll just probably grind around. And you could look. You're going to see. It's not unusual to see a little bout of profit taking or short covering heading into a Fed meeting. So that's it. Let's not spend too much time on the markets until we see which way it goes after the Fed. I'm going to hit on a few stocks that I want to, because they're key stocks and trades. Apple is still the Apple short trade. Again, not one of my favorites, but it's a trade idea, so I wanted to update it. And it also is the second largest component, last I checked, right behind NVIDIA. And so far, it still hasn't managed to clip our stop like NVIDIA has. I'll get to NVIDIA in 1 second. Not NVIDIA, I'm sorry. Carvana. Two meme-ish type stocks. Big ones, of course. And there's a little minor trend line, but I'm not crazy about that, so I'm going to take that back off. So that's it. So popped up, closed. This was Friday right here, closed back down below my stop line that I gave you. And again, if Apple continues up, if the market makes a marginal new high, so will Apple. So where Apple goes most likely is going to be dependent on where the market goes post-Fed. As I've been saying for a while, no reason to add or be aggressively long or short right now. again, better fish to fry elsewhere besides the market. Individual stocks are doing a lot better, both long and short. And that's, again, a function of, if you look at the broad market, you go to any broad market ETF. Here's the S&P 500. You just look at where we're at now, take a line here, and you can see we're trading where we were a month and a half ago. So if you're, frustrated because the only thing you're trading is an index ETF, well, you're not going anywhere unless you're just actively trading on the 5-15-minute charts, getting these little zigs and zags. So that's it. And again, bigger picture remains, this is the S&P 500, bearish engulfing candle, trendline break, back test, and big divergences. But again, divergences are not sell signals. On a related note, we'll look at VIXY. Or the VIX futures. There was a breakout of that little wedge. I give you, updated targets yesterday. Hit that first one, pulled back, and if the market doesn't like what the Fed is selling, the VIX will take off, has a potential to explode. And if not, when you look at the longer term, let's just look at the spot VIX. Let's do that. Remember, we hit that trend line. This is the daily chart right here. That was a 60-minute chart. Same wedge I gave you last week on Friday, right before the close. That's it. There's the primary uptrend line we keep buying at. We bought it here, and you keep popping after those. That's been the pattern so far. Pullbacks to this trend line have provided objective long entries. This is coming off a big divergent low right here. And as I said, sometimes the VIX starts to perk up, has these little spikes up to about this level here. And then one of those ultimately can really explode. So again, if that's going to happen, if it's going to happen anytime soon, I can think of no other catalyst better than the Fed somehow disappointing the market. But again, that goes the other way. And if it does, you can ultimately break that trend line, then probably come down to the next support levels. This is really, really good long-term support here. So that's it. It's almost a binary type thing. The market's either going to rally post-Fed. Now, watch this. We've seen also, I wanted to point out that the market, the VIX keeps making higher highs, and despite the market also making higher highs. So the VIX has had that resilience. That's one thing I'll watch for. If the stock market wants to punch out, make a marginal new high, does the VIX hang in there? It may give us some insight. So either way, that's it. That's your update for the markets. The stocks, I just showed you Apple. Carvana, showed you Carvana, the last couple updates here. This is on yesterday morning, I think it was, before I left. Somebody asked about Carvana, and I planned to do a video yesterday, but I said I took the day off. I was out boating. That's it. That was yesterday. So we're past the stop. Like I said, we hit T2 and have been waiting for a re-entry point, as I posted back on December 2nd. So that was a week ago today. Next sell signal coming to break this trend line. And there's the update yesterday. Carvana's still walking up that trend line past the stop. So officially it's closed out. We hit our second target for whatever the gain was, just well into the double digits. And so this is now the trend line that'll trigger a new short entry, and then I'll maybe add it back as a new trade with new trade ideas. So I already believe I have an alert set, but you can never have too many alerts set. So there it is. It's Carvana. And then the other one, just again, kind of random stuff. I did some trade ideas for you last week. Several longs, Iridium being one of them. That one was to trigger a long entry and a breakout above this bullish falling wedge pattern, which we've got. So far, the stock has rallied about 10%, and I wanted to highlight it because I gave you three targets on there, and we came very close to that second one. Also hit the 50-day moving average, which has been capping it since we were below it here. But we're coming back. We had a nice pullback today, so that's a breakout. And so now at this point, you can buy pullbacks to support. And this is support. You don't want to wait till it gets all the way there. Sometimes the buyers step in early. And that should take us up to these next targets. But again, if the market holds up, again, the Fed may, boost the market after tomorrow. Or again, the market may not like, for whatever reason, what they are selling, what they say. So that's Iridium. New trade idea for you, copper. We'll look at CPER if you want. That's one copper index. here. Copper index fund tracks copper, I believe, not copper stocks. I believe this one tracks copper index. Divergent high right here. Remember copper, we had a trade on it here. We literally nailed the bottom right there on that drop. Went long, gave you 2 price targets, both were hit, and we've been diverging. So this is it. You have this negative divergence. And let me show you COPX. These are copper stocks. They're going to move with the metal. It's kind of like trading GDX versus gold. And you can see also nice clean divergent high right here. Big negative divergence. Little volume spike. Potential buying climax. I'm not sure if I'm crazy about that volume analysis, but either way, there's an uptrend line. You can see targets 1, or trend line 2nd, 3rd, 4th, and potential 5th target. Let's see if it gets going. So copper futures, HG. HG broke down below this trend line right here today, triggering an objective short entry. You can see it's a wash, rinse, repeat thing. That was a divergent high. There was your trend line break, back test, nice drop. Another divergent high, trend line break, another drop. Divergent low right there, aka positive or bullish divergence, rally up. Divergent high, drop. So this is swing trading, guys. This is a metal that's pretty much gone nowhere, going sideways. But, you know, if you swing these little trends, you know, 5 to 10% just within the range, and then ultimately, again, I just showed you the longer term charts have potential for an even bigger drop. So there's a trade idea for you. Still objective short entry right now. And you can see if you're a futures trader, this would be the final near term target right here. That's about the 5-ish area. Right around the 5-ish area. So I wanted to take a look at bonds, something I'm keeping a very close eye on. I usually do watch, a lot of folks watch the credit markets for clues to on the stock market. Obviously, bonds are a very tradable instrument. I always say if you're trading Treasury bonds, you beta adjust up your position size at least 2-3 times what you might normally trade in the stock market on an index, because stock index, because they inherently move smaller in percentage terms, but the technicals work just as well. We shorted TLT there, near perfect entry off the highs on the break of that bearish rising wedge. And yesterday we hit my 4th and final target, which was the first of this uptrend line, which it was. That's what we hit, or that 87.24. So a little bounce today, but here's what I want to show you. So let's take a look at the actual Treasury yields. I'm going to start with the longest, the TYX, the 30-year U.S. Treasury bond. And, you know, it's not mere coincidence that my uptrend line on TLT, which is the, you know, tracks 30-year bond, coincided with the downtrend line on the yield of the 30-year bond. So that was my final target. It was hit. Now, the point that I'm doing this is to let you know that if this breaks out, you can see here Treasury's the 30-year yield had almost looks, it's an inverse head and shoulders pattern is what it is, and the top of that, the base of that pattern was right there, the neckline, and we broke above it. Now again, this is price resistance on yield, and more so this downtrend line, which now we have 1, 2, 3, 4 distinct reactions. So it's certainly a valid trend line. Fed's cutting rates tomorrow, or at least that's the expectation. But as I've talked about for over a year now, the Fed has lost control of the yield curve. They lost it back here. That was a rate cut. Long term, the 30-year bond yield went up. They cut again. The rates went up. They cut again a third time. The rates went up. At that point, they said, rut-row, that little Scooby-Doo rut-row moment, something's going on here. We're trying to lower costs of capital and, you know, juice everything, but yet interest rates that, you know, investors borrow, mortgages, car, and again, I'll get to the 10-year. I know the 10-year is closer. What tracks the 30-year mortgage tracks off the 10-year Treasury closer than the 30-year. But either way, I just wanted to cover that because it does matter, and it's also you know, the debt financing costs to the U.S. government as well. So watch for that. It is resistance. We did cover. And so nice, profits booked if you took it. That was the entry there in reverse. Remember, we shorted the break of the bearish rising wedge. So this is what we do. We'll try to milk the bulk of run. Now, if it breaks out, am I adding as a new trade area? No. I mean, you can certainly trade it if you want. That's, to me, the bigger thing is what that will do to the stock market. It will most likely cause concern in the financial market. So watch that level. I'm going to show you the 10-year real quick. 10-year is very important too. So the 10-year I have also at really nice resistance. So that's why yesterday's trade was closed out. I mean, it was closed out because it was a final target, but also this is really significant resistance. You can see what I have here. Let me change my tool to a box right here. I have a boxed in range, and that one again also looks, there was one little dip below. So you also have a potential inverse head and shoulders pattern there with the left shoulder right there, this being the head, and this being the right shoulder. And so if it pops, again, it's at resistance, and as I like to say, and often do, resistance is resistance until unless taken out. That's about a 4.2% yield on the 10-year. So again, watch this. It's what the Fed says tomorrow. Certainly can have an influence on bond yields. So so far we're at resistance. I'm sure the expectation for the stock market is we'll pull back here. At this point, I'm not betting on it either way, but if that happens, that can be viewed as nothing, in my opinion, but a net negative or a net headwind for the equity markets, financial markets. So watch for that. It'll be a breakout. Remember, we already took out, already broke above this bullish falling wedge pattern. It was a breakout and a back test. So if we continue up, this will start to increasingly worry the market. And you remember those levels I gave you way back when, a couple years ago. I have to go here to the 2-hour. I color-coded IEF. This is the 10-year Treasury bond ETF. So we're looking at TNX, what we were just looking at, the yield on the 10-year, in reverse. This is the price of the 10-year bond. And so the green zone is everything's okay. It's bullish for the stock market because yields are relatively low relative to where they've been in recent years. All right. And then the yellow zone is where the stock market will start to take note of rising yields. And you can see here, this is that uptrend line. Remember, we were trading TLT. You get more juice on the 30-year, but you can see we're right on it right now, right on the trend line for the 10-year, which again makes sense. I just showed you the yields also at resistance, price resistance at that box. So if this breaks down, that means the 10-year is broken out above that resistance level that I gave you on yields. And the bond will fall. And then again, it's incremental. If and as it continues lower, you get from the yellow zone to the orange zone where the stock market really starts to take note of rising yields. And then the red zone, which we haven't entered yet since I've given it to you a couple of years ago. Stock market will start to freak out. That will most likely take bond yields, 10 and 30-year bond yields out to multi-decade highs. Highs not seen since the financial crisis or beyond. So we're far from it, guys. I just want to say that, but again, something to watch. And again, if you're so inclined, you're welcome to trade it. I think we just sheared most of the meat off that bone, at least near term. So, and again, goes in line with why bet anything big in front of the Fed? It's just gambling. Like I always say, if you want to gamble like that, just raw gambling, go to Vegas. You can at least get free drinks out of it. Stock market's not going to give you those. All right, what is next? Oh, before we leave treasuries, let me just step it all the way down a little more and go to the 5-year yield. I'll show you what I see there. So remember, when you get farther down the yield curve, I started with the 30-year bond, then the 10, now this is the 5. You're getting closer to what the Fed affects. The Fed cuts or raises, they control the overnight lending rate. Very super, it can't get any shorter term than that, right? But this is the 5-year. The 5-year is also in this very, very well-defined trading range. Look at those 3 distinct lows, at least 4 distinct highs. Now, resistance is resistance until unless broken, right? So that's the only move you have right now at this very moment is to short bonds or short the 5-year, for example. Or I'm sorry, go long because this is yield. That would be, now again, that's not what I'm doing. I'm not doing anything in front of the Fed. But should we break out that's going to be very bullish. This is a very well-defined trading range. Remember, we have already broken out. This is a primary downtrend line off the highs. Lots of reactions too. We broke out of that recently. So if this happens, it will be a bit of more or less a WTF moment for the markets. So why would 5-year bonds be going up if the Fed cut again? So now, again, maybe it goes this way. But so far, the powers that be, as the odds of the rate cut have firmed up, you've seen the shorter term on the 5-year here, the 5-year yields going up. So that's a little bit, kind of moment. So just something to watch again, guys. All right. And again, if the market wants to punch new highs, you'll probably see an abatement of yields, maybe a pullback to this level. All right, so let's cover a couple other random trade ideas. Somebody asked me yesterday or the day before. It's in the comment section about GF. Oh no, that's the one that's already ended. That's the November. Let me get the newer one. Here it is. This is the January current contract. Highlighted the short entry there on the divergent high and the break of the wedge. And then recently we put in this strong positive, aka bullish divergence, gave us this rally back. And then on the way up, right here, I gave you a shorting zone, which is in this range. It has the top of this gap and the bottom of the gap right there. And so that's where I highlighted yesterday as an objective short entry there. And on the break of this uptrend line, you can see we have now off the lows. In other words, and again, just short-term trading stuff. Somebody asked about it. So it could be, very well could be the end of that counter trend bounce. Usually you're going to get at least 3 waves in a corrective wave action. So maybe a little pullback here, another thrust up. I don't have a strong opinion or position. I'm just sharing that because somebody asked yesterday. And again, you can see in the comment section the charts that I put up. Let me just hit on a few more commodities, ag commodities. Wheat, corn, soybeans. Let's look at the grains. Let's start with corn. This is the ETN that tracks it. Here's your primary downtrend line, and we keep pushing up on it. Remember, this was a divergent low here. We had a breakout entry there. Hit my first target. Or no, I'm sorry, it was back here. Hit the first target, pulled back, put in still divergent low, went up to T1 again, and that still remains a level that once we break out, I think corn prices will let loose and hit these higher targets. Now at this point, we still have to take out this downtrend line that keeps capping us. We've had 2 failed attempts to get above it, but a lot of clean reactions on it. And so that's the next breakout point. Price resistance there, 1882. And then again, that T1 level will be a big level. If taken out, open the door for a longer term move up. Soybeans, they tend to move together. Soybeans have already hit. They hit my first target here. They hit it again. They hit it again. Then they broke out. Went up to T23. So it's working its way up. It's doing what it should be doing if you're long. A series of higher lows and higher highs. That is the making of an uptrend. Certainly an early stage uptrend, but that's what we have so far after this downtrend line. So, and then wheat will follow those guys ultimately. It's been lagging behind lately. Looks like it had, must have had, 1 to 5 reverse split. What this charting platform does, they don't change your lines. They don't recalibrate, which most do. So then I have to replicate the chart again. But I can't. Yeah, like I said, I didn't have anything ready. I haven't gone in there since then. So I'll move those lines up. But it's still, you can see my divergence lines down below. I just have to pull up that other divergence line. So big divergent low. And again, it's going to follow corn, wheat, and soybeans. It's going to follow soybeans and corn ultimately. Most likely that's what these 3 grains do. All right, next up I want to share is lumber. Lumber's getting ready, looks like, for the next turn. This is lumber futures. Let me move this up so you can see it here better. There it is. Random length lumber. You can see down here, nice positive divergence forming. I always say positive divergence is not a buy signal. It is a condition, but we have nice divergence. There's a downtrend line in which to trigger a breakout. This is an end of day chart, EOD. So that means they update it every day at the end of the day. Let me show you the futures contract right now. Okay, these are lumber futures here, and this is a shorter term. This is an hourly chart, so 60-minute candles, 6 months of trading history. You can see most recently had a little wedge there, divergent high, and broke down, gave us this downtrend, but you can see much bigger divergence, the same divergence I showed you on the daily. This is what you're looking at here. And we actually have a breakout and a back test on this shorter term, again, intraday chart, hourly candles. So there's some potential targets, trade idea for you. If you're a futures trader, to the best of my knowledge, there are not any lumber future ETFs. They are only the wood and cut, which invest in forestry companies, paper and forestry. So they're, it's a proxy play on these guys if you want those two. Here, I haven't marked them up in a while, but this is wood, WOD. Again, getting down to about as cheap as these guys usually get. And then the other one is cut. They just hold a different basket of and that one, pretty much what I call an ADL, almost divergent low. We had an almost equal low, effectively for all intents and purposes enough, and then higher lows in the indicators. And so, and it's also at support too. This is what's contained all the pullbacks really since COVID, if you look at it. So the forestry, timber stocks are getting cheap. And of course, again, if lumber futures rally, these guys should as well. Okay, let me just wrap it up here. It's going to get into Bitcoin and some other things, but no, let's wrap it up here. If I see anything that stands out, I'll get it out to you. And again, let's give it another day or so. We'll see. Let the dust settle after the Fed meeting, and then we'll see which way the wind blows and what looks good. Like I said, commodities. Some of the things I shared with you, copper. Those have very little to do with what the Fed does. I mean, they can sometimes, if you get rate cuts and things like that, it may spur demand for copper or whatever else. But as of now, the last one, I'm sure I'll get some comments on it. And I haven't checked the site yet today for anything. UNG is back to T2, which is also support. Remember, yesterday I highlighted it. We pulled back to T3, I think it was. These are all the targets. That was our initial entry there. T1 hit, T2, 3, 4, 5 hit, and this is a pullback to now this former T2 level. It's still very much in an uptrend. It's just the nature of this volatile beast. I would call it the widowmaker. So, odds were favoring a pullback at that hit a T5 the other day, and it was also resistance on the futures. And it's been a run-of-the-mill for natural gas so far, a typical pullback. That's just the volatile nature of this. But if you turn off all the lines again and just look at what she's doing there, she's in an uptrend, higher highs and higher lows. If that continues, all the better. This is the charts I gave you, the longer-term swing targets on the daily chart. And that's it. Still coming off that divergent low, breakout back test, T1 hit, T2, halfway to T3, pull back here. So hopefully, ideally we hold no lower than T1. It's really nice support, and it was the breakout point from this basing pattern here. So went down a little further, that would still be an objective buy point, but I would not be adding below there. Doesn't mean it can't dip below and continue up and keep its uptrend intact. It's just that's really nice support that quote unquote should hold and contain any pullback at this point. If my read is correct that we're in we just put in a nice bottom here and we're looking at the next tradable uptrend like this one, which we milked from high to low last time. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.